Hello traders, welcome to FreeFX. Today is Friday, the 11th of December 2015. Now, as I promised in my last video, I was going to make another trading video, and this was going to be after the two rate decisions that we've had this week. So today's topic is going to be the idea of how to look at risk trends at the end of the trading year and really looking at what kind of situation we have on our hands. Here's our disclaimer. So we titled it Year Ends Risk Trends, which is slightly rhyming, but it really is all about where we are and how the market is positioning itself with the Fed rate decision coming up next week. So I thought I'd do a video to kind of sum up what's happened this week, and just like my last video before the RBNZ video was about what happened with the ECB rate decision, etc. This is incorporating that and adding the Bank of England rate decision that we had on Thursday and the RBNZ rate decision that we had on Wednesday this week. So let's start with just a view of sort of technical levels and where we are. On your left, you'll see the pound Kiwi chart for the daily, and I've put a circle down here at the bottom to show how we are interacting at the moment with the line in blue here at the bottom, which is a 200-day simple moving average, currently at 2.23. You can see the values here, 2.23 something. So we're just above it, and then today we bounced off it, so we came to pretty much the same level almost as the moving average and climbed up to, we're currently at 2.2534 as we speak. So it seems that this line in red, the 2.25 level, which we've been interacting for a number of days, and on the ECB rate decision day and then non-farm payrolls day, we've sort of been hovering above and then below. And then sort of these candles have been trying to press below it and then failed, and then we had this huge action here on the RBNZ rate decision day. So we'll come back to that in a second, but just to see that we are coming to these really important technical levels, and so I personally feel that there is scope for big moves ahead, because when we come to these critical levels and action is restrained or compressed, you can see that if you made a visual shape around that, you could spot, well, you could spot I'll just do that, and you can see you can spot a certain kind of shape. Okay, now that to me looks like yeah, so you could say that this is a triangle, okay, and every triangle really is bound to break. Okay, so the range is compressing here, and although you can see that the ATR has been increasing, when you look at the actual range here with this huge wick and the body being so small, we haven't actually climbed in terms of the actual body of the candle, open to close. We've actually decreased the number of pips at this point, and then the candle yesterday again, a longer pip at the bottom. So it is actually getting, compared to these candles, the range is getting smaller, and this sort of line here, you can see that it's compressing against the top line. So if the range is getting smaller and we are compressing around this very important level, and I say very important because it has been a level of importance back here in October as well, and we know that this range, this 1,000 pip range, is still in play. So until we've actually broken down, we're now pushing against the 200-day moving average. So we've got the 200-day moving average, and sort of running in parallel, we have these wicks, 1, 2, and 3. On the top, the wicks are getting smaller, and the tops are getting smaller. So this is going to break. Now, obviously, the big question everybody wants to know, is which way? Can you tell us, please? I don't have the answer to that, but what I can say is that risk trends have a big say, and this is obviously something that has been gathering gathering fuel to the year end. So the year end risk trends are very important for that reason, to give us that break, that sort of direction that we're lacking at the moment. And this pair is a pair, as you probably know if you've been following me, that I've been trading for a while, so it obviously is something I watch closely. Another thing that we look at when we're looking at risk trends would be outside the Forex spectrum, and for that reason I'm going to go to my next chart here, which is the FTSE 100, also known as the UK 100. I have been trading this long term and shorter term previously, and then more recently, that is in the last few months, I've been holding short on this long term trade. And it's a long-term break of the 6,000 level. Now you can see in blue here, we are currently at 6,006. So we're literally a bunch of pips away from the actual round number level 6,000. And I've put a pink line here to really make it obvious that we are on this very important level. And I say important again because we have interacted with this level. Now the line in blue is the S&P 500. I'll just take it off for a moment because it will make it clear to see. So back here in the month of June, we had this interaction with this level, okay, and then we bounced off it. So, but when you look at how we bounced off it, you can see that we struggled to get past this May top, okay, at 6,900, and we struggled throughout from May, June, July. We struggled through all of that, okay, and then we came to the highs of April at 7,100, so about 200 pips higher. But then we since the collapse had been much stronger with the Black Monday on the 24th of August, we came down past the 6,000 level, okay. So that's been where we've had the big move. Now I went short again on the break of this, just 2 days after that, on the 26th of August, and then it was coming back to break even at this point on the 1st of September, and then we kept sort of coming back to the 6,000. We broke again, so I was in profit until here on the 30th of September. Okay, so from the 26th of August we come to the middle of December. Okay, and that's nearly 4 months, 4 calendar months. It'll be less in terms of trading months because of holidays and weekends, but it's nearly 4 calendar months. 2 weeks for it to be a 4 calendar month long trade. So I've gone short here and I've had to wait, and so my drawdown was about 500 pips down up to this top here, 6,500. So you can see that there is a descending line, imagine an invisible line running across these tops here, okay, but even more clearly there's a top at 6,500. Okay, now what do we mean by risk trends? Well, look at the German DAX. This is another equities index, okay, and you'll see the very similar shape that we have, especially on the Black Monday when the Chinese market crash affected so many market areas and stocks and equities, and the correlation when something of that magnitude hits the wires is obviously very strong, and everything is moving in one direction, and that's really what we need to see to shape risk trends, not stocks going higher and perhaps or part of the markets being bullish and part of the markets being bearish. We need to see something that takes hold of everything and moves it in one direction. So when we see something like this, no matter how these independent equity indexes are moving throughout the year, then things are aligned, and it's much easier to also to look at further direction in the future. So the DAX is obviously moving in parallel to the FTSE 100. I took off the S&P 500, but if I put it back on, you'll see that that is also moving in the same direction. So let's put it back on. This is the German equities index, and the Standard & Poor 500. So you can see that again we are coming down towards the 2000 mark. It's currently at 2031. Breaking 2000, obviously, it's sort of the equivalent of breaking maybe the 6000 in the S&P 500. Sorry, in the UK 100. So we sort of struggled to get past this 2100 again, and coming back down. Now we came down to 2000 almost down here in the month of November. So we're coming back down. So like yes, the UK 100, we're sort of moving in what we see as these humps. Not making progress, trying again. Could this be the right time? Well, for that, I'll go to another chart, which is here. This is the investing.com website, okay, and this is the FTSE 100 chart. So let me just squeeze it in so you can see where we are. Okay, so this is the FTSE 100. Now I'm going to move that along so you can see where we're at. Now we gapped down for today. This is a daily chart. We gapped down and we're coming basically to test this 6,000 level that I was talking about. And what you see in respect of this, which is why I'm showing you this, is that we have volume figures down at the bottom here. So you can see from the volume that volume has been rising. Now red means selling volume. So from here, which should be the 3rd of December, we've had decreasing volume. So after this initial push, volume has been coming down, and then it's been increasing again. This black line would be the an average, okay, an average indicator. So it's been rising, and so we have a push. So this is actually January volume. Now you can see on the 24th of August, again, this the Black Monday, volume was quite high, okay, up here to 1.7 billion. Okay, here we're at about 864 million. Okay, so it's about half of this Black Monday. So volume is quite high at the moment. So it's sustained volume pushing this quite strongly. So this is a genuine move because we have the size of volume and the candle size as well seems to reflect that. So it's actually a genuine sell. Now, we don't know what's going to happen. Obviously, this is the end of the week, so this may struggle to go past 6,000 and it may just stop there dead. Okay. So from my point of view, having entered just below this level, I'm now pretty much at break even and I'm looking to, again, holding short for a continuation. Now my drawdown came to about here, so about 500 pips. So I'm looking to basically on one-on-one, so one-to-one rather, and that would be about 500 down. So I'm looking at about 5,500. Okay, so that about that level, and then exit, roughly there. Okay, so that would be the same as my risk essentially. Now, what this tells us is that if we have volume and it's selling strongly, okay, we have volume and we have a deleveraging market, which essentially tells us that if you look into the FTSE 100, the individual performance of the individual companies, you will find that obviously there are things that are affecting this. I'm not really going to go into this much, but if you had if you had something like oil, crude oil would be the Western Texas WTI index and crude oil. Yeah. Okay. So this is crude oil, and you can see that we're currently at these levels here, which is it's fairly low. Make it bigger. If we can see the sorry, so this is slightly awkward trying to get the price, which will be all the way to the right. It won't show it to me for some reason. Make it full screen. There we go. You can see that the prices come to these levels, 36, 37 at the moment. So we have these moves, and obviously you can see a correlation between US oil and the FTSE 100. And if we wanted to make it even more obvious, we can have it on here. So I'm going to close that, remove it, and actually add a price overlay of the US oil, crude oil. Okay. Now we can see them on top of each other, hopefully, somewhere. Can we? Okay, so there is actually the there's the level there. So this is the US oil. Okay, so you can see that oil has been falling, and a very similar shape here with the FTSE 100. So this is quite obvious. You don't actually have to really add anything to that. Visually, it's obvious that there's a correlation. And one of the things that becomes obvious when you look at the FTSE 100 composition is that it's one of the highest earning, or the one with the highest investment company in the index, Royal Dutch Shell. Okay, the third largest is BP, British Petroleum. Now it comes to understanding why oil is falling, which is to do with supply. So if supply of oil is too large for price to pick up, there have been comments about how far will oil fall. We're at 36.29, and I pulled up a chart the other day from I think it was the 1950s onward, and during the East Asian crisis, 1997-98, it came down to about $17 a barrel. So there are historical precedents. During the Gulf War as well in 1991, price went down and then picked back up and then back down dramatically. So there are swings like that which are to do with supply, but also with concerns. If there's a country like Syria, for example, which has was a lot of interest in reviving a derelict pipeline. And there are obviously issues of control over the territory between West and Middle East. So when there's a war like the Gulf War for the control of oil, if oil becomes a particular supply, a pipeline, etc., becomes a sort of a prize to be won over two warring factions, then access will be restricted, demand becomes higher for something that is less available, prices go up. So there are things that are going on at the moment in the region which would suggest that the price might actually go up. Instead, we're seeing the opposite, which is the price going down. This is to do with world supply. They call it a supply glut, so that's basically oversupply. But this may turn for something like a conflict in the area, or where producers lose access to a vital supply area, and so a production area becomes unavailable because it falls into the hands of combatants or enemy combatants, or there's ISIS trying to expand and seeking control of areas, perhaps which would affect price of oil negatively, meaning that oil will become more expensive. Now, this is all speculative, but what I'm saying is that there is a connection between oil and UK 100 companies. So there is a risk trend there between commodities, certainly the energy commodity of oil, and the FTSE 100. Now, let's take the oil chart off here, and I'm going to add something else here, which is the overlay for the pound US dollar. I've just changed it to that. Instead, I'm going to overlay it, which is what I wanted to do in the first place. So let's go back to FTSE 100 and overlay it with the pound dollar. So this is the cable. That's the daily. Let's see what we see. Now, what we can see is that we have seen the pound trying to shoot higher. Okay, and the pound has come to try pushing back up to 160, failing, and it's struggling down to this kind of big support line at 150. Okay, just pushing higher. It's at 150, 155 at the moment. So that's where we're at. Okay, now you can see that the FTSE 100 and the pound. Just make it a little bit more obvious if I can. Okay, so they have been in lockstep almost with a falling FTSE 100 and a falling pound. Sometimes this correlation is not actually like that. It's inverse. So it's not you know, as the pound appreciates, the FTSE 100 depreciates. Okay. Just have an example of that. So okay, here's a good example. So back here in 2012 and into 2013, see the cable depreciating and the FTSE 100 appreciating. Okay, and that's a long run. Okay, it's from December all the way to May. That's 5 months. So there are times when this is an inverse correlation. Currently, they seem to be running in lockstep. So the pound is depreciating and the FTSE 100 is depreciating. And the support line seems to be for both a round number level at 6,000 and 150. Okay. So the pound is waiting for release from monetary policy from the Bank of England. The FTSE 100 is waiting for release from commodity deleveraging, so US oil just losing value and tumbling. And until that trend is reversed, the FTSE 100 is obviously in lockstep at the moment with US oil. Quite clearly, we've seen this straight fall. Okay. Now, obviously, there are individual companies, like commodity companies, as we said, Royal Dutch Shell, which influence the index. But as an index, speculatively traded, you know, this recent downtrend, 500 pips down, as part of a bigger trend from here in April. You know, this is obviously showing signs of fatigue at levels which are multi-year highs. If you put it down to a monthly chart, you can see that. Okay, we're sort of up there. I've shown this many times how I see this as a cycle, and we reach the top. This is the first leg of the first cycle. The second cycle again at similar levels. Third cycle similar levels. The leg up usually has been quite steep, and the leg down quite steep. This leg up has been sort of broken in two halves. It's taking a little bit more of an awkward journey, and there's been much more accumulation and consolidation up here. It's taking much longer, much more chop, but we are moving sharply down. Okay, so it's again, this 6,000 level has been influential before. You can see it's been holding up before the final break and before we came close to it, and then push higher again. We'll come back down to it. So, and this is 2011, 2012, broke in 2013, and we're back down here in 2015. So 7-year cycle. Now we're at the end of that 7-year period. So this is make or break time. With equities, not just the FTSE 100, as we saw the German DAX as well, pushing lower, the S&P 500, and with it commodities. So we're starting to see a move down that's affecting several asset classes: equities, commodities, Forex. With that in mind, we really have at the moment this sort of waiting game, and what we're waiting for is the what's happening next week, which is the now you can see there is a lot of data next week from various corners of the market. I'm not following all markets and all currencies, I'm concentrating on the pound, Kiwi, dollar, and the euro. Now you can see that the dollar has core CPI, the pound has CPI, all very influential data because obviously inflation is one of the targets for the Fed and the Bank of England. You have employment figures for the UK, the British employment and unemployment situation, but the main event on the 16th of December. And this is going to be absolutely market moving. So we are coming to the end of the year. There is less movement in the markets. We see these levels, the 150 in the cable, the 6,000 in FTSE 100, for example, for the UK. For the US dollar would be critical levels like the 12,000, 12,200, that range of 200 pips at the moment. For the S&P 500, obviously, it's the 2,000 level. Breaking below that would be a major achievement and opening the door for a bigger sell-off and deleveraging. For oil, obviously, we are below 40, so 30 would be the next big round number. For the Kiwi, we'd be going below 0.65, which has been holding as support for a while now. So all these levels are going to be holding up until an event of this scale. Now, on the 16th of December, we're going to get a number of things. We're going to get the Federal Open Monetary Committee economic projections for 2016 and possibly 2017. So medium term, we're going to get the chair, Janet Yellen, is going to read out the statement. And the interest rate decision as well, which is expected to be up by 25 basis points. And we're going to have a press conference at 7:30. The press conference will be really where I think, well, the statement is going to provide a lot of detail, so markets will be waiting, and certainly there will be a lot of front running in the days coming up to that. But I think for real trend beyond front running short-term moves, we need to wait, and I think the markets will be pretty quiet coming up to that statement, as well as the rate decision. There'll be an initial move, as we saw on the Reserve Bank of New Zealand. Big move was actually Kiwi negative move, in this case pound Kiwi, so obviously positive for the pound, and then it reversed, so the Kiwi subsequently rallied. So there could be a big dollar push, and then subsequently there could be a dollar sell-off. It depends what comes in the statement, really. So here's a move from the Reserve Bank of New Zealand. It pushed down first, and then it went back up. Okay, but after the big move above this 0.67 50, okay, we came up to 67.75, and then we're currently at 67.40. Okay, so we've not really made progress. So this could be something that happens on the day where the rate decision is given, and we'll with all probability is going to be the rate hike that the markets expect. If the rate hike came at 50 basis points, then this could be a surprise because less people expect that. Potentially is going to be a major push because obviously less people will be positioned for that, and be some adjustment, and so that would have a greater impact. But what really matters is after the first 5 minutes of the rate decision being given, then the market fade. You know, what comes up after that is the statement being read out, which will give a clue as to the future direction of the Fed. So if the Federal Reserve statement, and Yellen said, for example, we will implement further tightening and further rate hikes in the first quarter of 2016, that would be a very strong direction from the Fed into bullish sentiment. So that would really have a continued push for the dollar. So this would really get the markets rallying beyond an initial swell of volatility. So something like that is really what the dollar needs to break above current levels. That's what the S&P 500 needs to break, and really a sell-off, and the FTSE 100 sell-off. All these indexes will be influenced similarly, because when we saw, for example, let's see, FTSE 100. Now this is a European based index in a way, because although it's the FTSE 100 London based, when the European Central Bank on the let's see, hourly, sorry, I put it back to the daily. On the 3rd of December, we had the ECB. Now, this was very negative. Why? The euro rallied, the dollar sold off, and the FTSE 100 sold off. Why? Well, obviously, more easing means that the companies that invest in Europe, easing is a sign of a central bank trying to stimulate the economy. It is, as I see it, a sign of a no confidence, both in a particular set of government initiatives and policies to help the economy grow. So Draghi is trying to send a message to the governments of Europe that he's doing half of the job, and they need to finish the job by implementing action plans to get the economy back into shape. He can only do so much. So the euro rallied because the market was expecting that QE upgrade, and it didn't beat expectations. It just met expectations. So it wasn't the euro rallying that pushed the FTSE 100 down necessarily. It was this correlation between economies. The European Union is the UK's largest commercial neighbor. So a struggling Europe obviously is a bad deal for UK companies listed in the FTSE 100 index. But we can sit here and talk forever about how we interpret a particular event. What we're really interested in is how we make money. It's how we interpret probability and trading going forward. We can't predict the future, certainly, but we can give ourselves the best chance of trading in the right direction. So at the moment, as we stand, the Federal Reserve rate decision next week and statement and the press conference will be an amazing opportunity for us as traders who invest time and money into this field, and for markets generally, to get a sense of what is going to happen. From reading and keeping my eyes open to various sources of information and websites, my feeling is that the market may, and I say may, take a Federal Reserve rate hike and aggressive monetary policy going forward into 2016. So further rate hikes into 2016 as a sign of the end of funding for investment in assets which have been essentially supported by the government asset purchases. So as I see it, from how the S&P 500 has been responding to news, that the end of QE, the second QE, was coming, the tightening of 2014 into 2015 for the S&P 500 has been obviously bad news. See here from the last rally here, end of 2014, Okay, we've had quite a lot of selling off, okay, in the S&P 500 below the 2000, okay, up to January 2015, and we stayed above it, but it never really quite picked up. And the scare from the Chinese markets here, 2,100 to 1,800 almost. That's 3,000 pips for the S&P 500. So that was a massive move, and it managed to recoup all of it, but it's not sustained it. So this uncertainty is waiting for something like the Chinese market crash of August to again keep profits, close positions. It's the perfect time. Imagine the last Friday of the month, the triple witching, the expiry of contracts, futures, and the end of the year. The financial year ends in December. For some countries, it's April for the tax year in the UK, but it's the end of contracts in December. It's the Santa rally factor where a lot of people will be expecting to close in profit, but also the fear of not making that profit and wanting to preserve capital. There's a lot of obviously psychological elements to the end of a 12-month period, which don't need to be explained. So something of the magnitude of the Fed rate decision is the quarterly rate decision, so you get a full statement as the press conference, and also the highly expected first rate hike in years. This is going to be the perfect opportunity for whoever moves these markets. Let's call them hedge funds, combined with institutions, combined with what they call smart money, whatever you want to call it. Whoever has the power, or the combined power of several of these market movers who will think in the same direction after so many months of indecision. If this sentiment is equities negative, it's capital negative, it's closing positions, taking the fuel out of this long-term rally, okay, from 2009. 6 years of buy and hold mentality. This is going to be an opportunity for things to finally take a unilateral position to the downside. How is this going to be for something like the Euro-US dollar, which since the ECB rate decision rally has not really moved far? We certainly struggle to go much higher than this. We can see we're at 109. Okay, we had 2 down days after the ECB rate decision and 2 up days, but we stopped at 1.10 and it sort of stalled. So the US dollar has been struggling around these levels. Okay, so this was the ECB rate decision day. Dollar down because a lot of the waiting for this index is in the Euro USD exchange rate. So with the euro rallying, this fell. But the dollar is not really in a downtrend. You can see it's quite the opposite. It's in an uptrend from 2014. Since the conversation began about tightening and about rate hikes, the dollar has sort of been waiting for this event. There are some voices that call for the Fed rate hike to be actually an opportunity for the dollar to move to the downside because it's overappreciated. Okay, but we don't know that. Okay, so certainly if this were dollar positive, there'd be a lot of pairs like the pound dollar would depreciate because the Bank of England has been very dovish. The last rate decision this week has seen the Bank of England, again, the Monetary Policy Committee, voting 8-1 to keep the rate unchanged. And so that was on the 10th. You can see that very poor reaction. The market expected that. Certainly a negative reaction, but not a big one. And certainly didn't break above 152. And so we're kind of stuck between 150 and 152. Okay. It's been a sort of downtrend on the daily chart. If you look from August, we're moving zigzagging down, lower highs, lower lows. So you could say that we're in a shorter term downtrend. and this could be a continuation of that downtrend. Equally for Euro US dollar, we're in a downtrend. We're just sort of coming down to this 105, and maybe this will break 105. And so with other currency pairs that have been waiting for this event, Kiwi US dollar, yes, we had the rally, but really, this is the hourly. Let's put it to a daily and see the downtrend really still continues. Okay, that's kind of waiting. And that's the downtrend there. You can see it. Long-term support here, but shorter term from, say shorter term, but really from July of last year. It's been a downtrend, still below that 200-day moving average. Okay, so we could break below this this support line. So there's a lot resting on this event risk, and I am still long pound Kiwi. Okay, have been long since 2.46 more or less, and been holding because we're above this 200-day moving average. So I'm up here. That was the Black Monday day, big candle, and I was expecting it to continue higher. I waited, and then this recuperated quite a lot of lost ground, 2.35, back down to 2.25 more or less. And I expect that the mover for this, which correlation for this has been for the entire year pretty much, has been the Kiwi dollar to the downside. Which one is going to drive this pair, the pound dollar or the Kiwi dollar? Well, pound dollar and Kiwi dollar are both dollar related, two majors, and they will both drop on a bullish Fed. So one of them has to give way to the other, you know. So it will be the Kiwi dollar that drives this pair once again. The Kiwi dollar will be to the downside, pound Kiwi will be to the upside. However, on the actual hour of the date release, of the Fed, of Yellen coming out speaking, there may be a lot of confusion in this pair, because obviously there'll be signals coming from the two pairs, the pound pair and the Kiwi pair, so there may be a lack of direction, but eventually I expect this to be rising on a Kiwi short move. This will rise, and this pair is very volatile. If you look back here, we had 400 and nearly 500 pips daily averages. We're back down to about less than 300, but you know, we've had big moves in this pair in the past, and you know, if this pair were to rally 500 pips in a day, that would be pretty normal for this pair. So you know, this happened on the day of the Reserve Bank of New Zealand rate decision. It moved 500 pips in one day. In fact, it was really, that move really happened in the hour in the evening from 8 till 9, where they had the press conference after the rate decision. And you know, 2.25 to 2.30, that's 500 pips, you know, top to bottom, and that was one big wick with a very small, so a huge doji basically. Now dojis are a sign of indecision, but if we had a sort of mini downtrend here, is this the end of the downtrend and the beginning of the recovery, or is it just a doji, or is it the end of this uptrend and the beginning of a reversal down? Because we've not really had a reversal. As far as I can see, this is a correction. The bigger trend is really the one from April, from 190 to 2.46. So that's the uptrend, and we are still above the 200-day moving average. So yeah, we could see that as a doji sort of reversal candle, this correction, if you like. But who am I to say? So at the end of all that, 500 pips projected in a day from 2.25 to 2.30, and maybe breaking back above that, and then signaling that the next break would be above the 100-day moving average, currently at 2.3417, so back above 2.35, and that would really open things up to the end of the year, what happens in a time of low liquidity is the trends are weak, but certainly the least, the path of least resistance is what we want. So if the path of least resistance is a continuation of this trend, then that will open up towards the end of the year into 2016 without much trouble, because there'll be no event of the magnitude of the Fed rate decision after going into Christmas and New Year's Eve. So but at the end of the day, we need liquidity to have strong trends. So it may be that it would be a break but no follow through, just waiting for the resumption of the normal quote unquote trading conditions in January after the New Year break. So certainly there are trends here in the making and reversals in the making, but we need that conviction and the return of liquidity conditions to really make it happen. So at the end of all that, I will finish by wishing you a great weekend and looking forward to all the action next week with the Fed rate decision on the 16th. So thank you very much for listening, and happy trading.